Insights of the news shaping the markets, and for that we welcome in Jay Hatfield, founder, CEO, portfolio manager, Infrastructure Capital Advisors. Jay, thank you so much for being with us. We heard from the Fed. We got some great claims in today. The market has now gone back to that selling season. What's going on here?
Good morning, Nicole. Thanks for having me on again. What really we see happening is you had a little bit of relief rally when the Fed came out with their dot plot and Chair Powell had the press conference. But then what I would call erratic communication from the Fed has taken us a leg down. It seems that Powell neglected to mention that they actually had come up with a number for the tapering of 95 billion, which is above market expectations. And also he failed to mention that he was sympathetic to this 50 basis point increase. So that's taken us another leg down here. We think there's some support for the market, S&P at 4,400. And the reason for that is next week is earnings season. And we think earnings in general should be positive and will be a positive catalyst for the market.
A positive catalyst. So if that's a positive catalyst, I mean, we'll kick it off with a lot of the bank earnings, right? But I think that when you talked about the 50 basis points, I think the part that I think is so fascinating is that the Fed, and we heard from Brainerd, and they're willing to sacrifice some growth, it seems, in order to tame inflation. Does that part worry you?
Well, certainly we're in dicey times because the Fed is lurched to being hawkish from being ultra dovish, inappropriately ultra dovish. So that's risky. The Fed there's been 18 tightening cycles since World War II. 11 of those have ended in recession and only 7 in a soft landing. So it's perfectly reasonable to be concerned. What we think is the most likely case is in the second half, the two critical sectors, housing is likely to slow some, but not crash. We have really a shortage of housing. The ratio of housing to households is below the 50-year average and way below what it was in 07-08. It's about 110% of housing to households, and it was 120. So we think housing's okay, and we think energy is finding a level around 100, so it'll get capped out. So we think inflation will get better, and the Fed will become more dovish in the second half. It won't take us into a recession, but that does remain to be seen.
I'm glad you brought up the 95 billion, right? I think that a lot of folks had been talking about the surprise, right? 60 billion in treasuries, 35 billion in mortgages. So they'll continue that. It'll probably be over $1 trillion in a year. That would equate at least probably a couple of rate hikes itself without even actually doing rate hikes. What I did think was interesting, conversation I had yesterday, Jay, tell me what you think. You mentioned how Powell acknowledged that he was considering 50 basis points, but because of Ukraine and took a pause and decided to do 25 basis points. Do you think there is some empathy to the market or what's going on here at all? Because if there is still war in Europe, if the war expands somehow, how are they going to get in there and just start doing 50 basis points?
Well, like I said before, we do think the Fed is being erratic because they have,
right.
What they haven't acknowledged is they've already really accomplished their objective. Their objective really should be, and another data point is 11 out of 11 post-World War II recessions have been preceded by a housing decline or even crash. So the key sector for them to cool off is housing. And they've already moved rates just by talking and not raising,
right,
from 30-year mortgages of 280 to really almost 5%. That's absolutely going to cool off the housing market. We don't know how much. So they should be more patient. But yet again, really ever since Greenspan, the Fed has been highly incompetent. Groupthink is worse than, Volcker or Greenspan. So it's entirely possible they make another mistake like they did in 2018. But we're optimistic. There's new Fed governors coming on. we're optimistic they'll be more reasonable and recognize there's a lag in monetary policy, and therefore they'll see this cooling in the second half.
Okay. And so with all of that, I'd like to get to some of your recommendations or what you see that might be working at this time. I saw you have dividend payers, right? Pipelines, some large cap energy, telecom utilities. You like preferred stocks as well, REITs, which often is a real safety play. And cryptos could crash. Tell me a little bit when, these were just some of your ideas here. We won't have time for each one, but I am curious where you think money should go.
Well, we think there's a little bit of a misconception around what's driving tech stocks and crypto lower, or at least was going lower. It's not really interest rates. Rising interest rates are bad for really all investments because all stocks are long duration assets and preferred stocks are too. But really what it was is the decline in liquidity. We had a bubble last year in tech and arguably cryptocurrency. This year, you're seeing that bubble decline. We think that's going to get worse in the second half of the year when that $95 billion is going to come out. So we do think, just like yesterday, you'll have that kind of market where the conservative dividend payers, stocks that we own in our strategies, are actually up on days where tech and the more risky, higher beta, higher volatility names are suffering from the prospect of liquidity coming out. And then the other great thing about buying dividend stocks, as we've said before, is you can be wrong and still be right because you're getting paid to wait. Right. You reinvest your dividends. So it's not like I'm saying go buy Dogecoin. You're buying great conservative household names that pay you dividends. And in the case of preferred stock, you're senior to common, so you're getting paid before the common shareholders. So we think it's a year to be cautious. We've been saying that before the year started, but it's sort of more obvious now with the super hawkish Fed, markets down for the year. And these defensive stocks have already outperformed. We think they'll continue.
Thank you, Jay, very much. Good to talk with you. I appreciate it. Jay Hatfield, Infrastructure Capital Advisors. Thanks.
Thanks, Nicole. Thank you, Nicole.